And good morning, ladies and gentlemen. You're all very welcome to this session on valuing the true cost of greenhouse gas emissions in the financial services sector. So I'm Dorothy Maxwell. I'm the director of an organization called TEEB for Business Coalition. And just to explain, we are a coalition of organizations that are already global leaders on natural capital valuation, and we're coming together to scale up action in that area. So today, this session is focusing on how valuing the true environmental externality costs of greenhouse gas emissions can support the business shift that we're talking about today from business as usual to positives and net zero. And particularly, we're looking at the role of the financial services sector. And that's because they are pivotal if we're looking at market transformation shift on sustainability because of the investment decisions they make in their environmental, social, and governance assessment processes. So if we look at the business case for valuing environmental externalities for greenhouse gases, but also for broader, this is really an area that's growing, and hence the reason for us including it at the B4E Summit today. And in the TEEB for Business Coalition, we produced a report in March, and it was about framing the business case and identifying the priority environmental externalities, and of course greenhouse gases were covered in that. But just to give you a flavor of the scale of this issue, we identified that per annum, the top 100 environmental externalities of business were costing of the order of $4 trillion US. That's staggering. And these are basically costs that are not currently included to the large extent in the business model. And as we go forward and see increasing resource scarcity, erratic weather conditions from climate change, all the kind of issues that we're talking about today, the internalization of these costs and the pressures on the systems and the costs associated with them are just increasing. So hence the reason for this topic becoming more interesting, the reason for businesses, but also investors wanting to understand what these costs are and what the risks and opportunities, what the assets and the liabilities are associated with them. So that's the background for today, and what we'd love to do over the next 45 minutes is frame this business case more broadly for you. We're going to frame it in terms of what does it mean for a business, but what does it mean also for the investor, so we'll take that broad approach. We look at some of the emerging issues that are coming out for valuing environmental externalities, greenhouse gases and broader. We look at some of the issues associated with those, the challenges, and where do we go from here. Of course, we're going to involve you in the conversation, so if I do my job properly, we will have time towards the end to bring in your questions. So as they come to you, please take note of them. We have a panel with us of key experts who are working in this field in a range of different areas. So what I'd like to do is turn to our first panelist, and this is Ivo Mulder. Ivo is the coordinator of the Biodiversity and Ecosystems Program at the United Nations Environment Program Finance Initiative. And Ivo, UNEP FI has been working for the last 20 years with financial institutions on this topic. What is your perspective? Where have we come to on this particular topic?
Thanks, Dorothy, and also good morning to everyone. UNEP FI started in 1992 as the first initiative that aimed to mainstream environmental, social, and governance issues in the financial sector. I think we've gone a long way from then. It primarily focused at the onset about communicating the importance of ESG in a very qualitative way. And after setting up a number of sub-industry standards that we were involved in, such as the PRI, the Principles for Responsible Investment, or the insurance equivalent that was launched last year at Rio+20, the Principles for Sustainable Insurance, we're now moving towards a more quantitative approach, trying to capture and quantify the risk exposure, especially in relation to environmental topics, but also in social and governance factors. And I would say this is especially important for the finance sector because only what gets measured can be valued. And the two topics that I would like to highlight here in this panel are the GHG protocol scope 3 emissions for the financial sector, where UNEP is partnering with the greenhouse gas protocol to come up with a standard for the financial sector to quantify indirect emissions, basically emissions through loans, investments, and other financial products. I think it's very important because the financial sector on the one hand can play a super important role, but across the board, even though I think there are a lot of good things are happening, very few institutions at present understand how they can either lose or gain money through this. So I think there's a big step to make, and I'm really applauding the organizers for the ambitious title that we've put ourselves on, net zero and climate positive. But it's a long way from where the financial sector is at the moment.
Thanks so much for that, Ivo. And I'd like to introduce you now to Richard Mattison. Richard is the CEO at Trucost. And Richard, Trucost are in the business of developing a lot of the approaches that are now emerging for doing this valuation. What's your perspective for where we're at?
Thanks, Dorothy, and good morning, everyone. Essentially, the way we view this is really a problem of flow of information. So I was reflecting this morning, actually, on the way in. It's actually been 7 years since the Stern Review identified climate change as the greatest and widest ranging market failure ever seen, which is quite a long time. So I was thinking, what has happened since then? Well, actually, we've had a global financial crisis, and that crisis was, by and large, caused by a lack of information flow. The individual actors in the investment chain were not aware of the entirety of risk. It's system-wide contagion risk. And essentially, we're facing the same problem here. We've got a lack of information flow in our financial markets. And that's actually impeding our progress. Because without that information flow, there is no strong business case for institutional investors to act. They don't see why there are any liabilities associated with the current investments they make. They don't see why they should be the first to act. And yet, actually, they all suffer from the potential to incur huge liabilities, as the latest report that we've done with the TEEB for Business Coalition has identified. So $4.7 trillion is the risk associated with the top 100 environmental externalities globally. If you add that all up beyond the top 100, it actually adds up to $7.3 trillion. And just to put that into context, that's about 25% more than the combined losses of OECD pension funds in 2008. So how much was wiped off in 2008 from our pension funds. So really we're facing a risk that's actually larger than the global financial crisis we've just gone through. So what do we do about that? Well, essentially, our view is that there needs to be more information flow between the actors in financial markets and between financial markets and the companies and other types of investments that they make. So that really means that companies who are doing sustainability initiatives and doing great work, from what I've seen, should be talking to the investment community in language that they understand, should be describing the net present value of sustainability initiatives, which of course many companies in this room are. But if you look at the broader marketplace, there's a real lack of information flow. And likewise, investors and all the different aspects in the chain of investment, from pension funds, pension fund consultants, through to asset managers, and also investment banks, should be incorporating externalities into their analysis. The problem could be encapsulated like this. There's going to be 3 billion more middle-class consumers by 2030. That's a huge opportunity. That's growth. We need growth right now as a global economy. That's fantastic. But by then, demand for water will outstrip supply by around 40%. And crazily, currently in the marketplace, there's a negative correlation between the price of water and how scarce water is. So we've completely mispriced water. We've got a serious issue with the stock of water, and therefore the stock of things like soft commodities and raw materials as they flow through the economy. And yet we've got a huge demand. So if you place a number on that, that's where we get the $4.7 trillion. And that's what we think needs to be communicated between companies and their shareholders.
That's excellent. Thank you, Richard. It really puts the risk in context. And now I'd like to introduce you to Francis Way. Francis is the COO at the Carbon Disclosure Project. Francis, again, CDP have been in this business for a very long time. What's your perspective on this emerging area of externality valuation?
Well, at CDP, I mean, we believe that to drive any positive change, you need to have measurement, you need to have transparency, and you need to have accountability. Until you have that, nothing's going to change. You're not going to be able to see any progress. We've been successful at CDP in sort of working with existing market relationships, so leveraging the shareholder relationship with the company to incentivize companies to report. If companies feel their shareholders want this information, then they start to think about it. And I think we've been successful on that level to date. We've also expanded since 2007 beyond carbon to ask companies about water. We did a merger last year with the Global Canopy Programme and took on their forestry programme. And we're now also investigating further natural capital and really where there might be impacts for business and where we're not covered so far. In fact, looking at your recent report, the Trucost TEEB report, we did feel that through forestry and water and climate change, we were doing quite a lot. So hopefully there isn't too much more that we'll have to be asking companies. We know investors are interested because in 2003, we had 35 signatory investors. This has grown 20-fold to today. Now we have 722 signatories with $87 trillion in assets. So we know they're interested, but I think when we're looking at it, they're looking at the profitability per company that they might have shares in, but they're also looking at this as a sort of systems change and the effect on the whole economy. And they know there's the need for the information there, but there's still a lot more to do in sort of enabling that information to really be used and to drive change. So I think, one of the things is not to just look at things like carbon. You need to look at the whole cost, the whole value sort of side of things in terms of the regulatory impacts, the reputational impacts, the actual cost of climate change in physical effects and things like that. And once investors really understand all of that, then I think we'll really see incentives for companies to change as well.
Thank you for that, Francis. And the final member of our panel is Douglas Johnson. Douglas is the Head of Climate Change and Sustainability Services at Ernst & Young. And Douglas, from your side in Ernst & Young, could you frame the business case for us for externality valuation?
So I'm not the head. I look after UK and Ireland, but it's a very grand title to be the head globally. So thank you for that elevation of my position. The work that Ernst & Young does is largely with large corporate organisations, and climate change and the management and mitigation of carbon emissions represent very significant business impacts and potentially threaten the future of organisations. So we spend a lot of time helping our clients understand how the climate change agenda impacts an organisation, where are the pinch points within their business. But where they're often lacking is trying to put some numbers around that, not just number of carbon emissions, but actually what does that mean in terms of cost for your business, in terms of lost revenue, in terms of customers willing to come into a shop and actually buy your product. What does that actually mean tangibly, such that you can make appropriate business decisions about where you invest, what you mitigate, and what your future strategy is and how this impacts upon it. There's a lack of a reference point right now to enable organizations to make those appropriate decisions. Certainly our view is that the valuation of externalities is one part of that. But actually businesses, whilst they do care about the impact of emissions on society, it's primarily how do those externalities translate into internalities such that it impacts our business now and also for the longer term. So it'd be interesting to have that debate. But it's great to be here with all these other panel members. And Dorothy, thank you for inviting us.
Not at all, pleasure. And Ivo, if we could come back to you thinking about the financial services sector specifically, what do you see as the business case for that sector, and could you give us an example?
Sure. I think first of all that the financial sector is lagging behind many other private sectors in terms of pressure to account for both carbon and natural capital in their business. But also within the financial sector, that pressure is increasing because of regulation and legislation, because of activist groups shifting their focus not only on the companies that are being serviced by the financial sector, but also to the eventual the institutional investors that are holding the assets on the books, or the banks with respect to the loans they have on the books. I think the business case is growing. The natural capital at risk report showed the tremendous amount of externalities and the magnitude in relation to the revenues that key private sectors are making, and I think it's important to communicate it to the financial sector. Another example is the carbon tracker report, which came up with a very interesting study showcasing the staggering amount of money that they've put into developing new oil and gas reserves. I think the number mentioned was 670 billion. That's the amount of money simply to look for new reserves. Whereas if you would see what actually can be burned, it means that up to 60 to 80% of reserves cannot be affected or cannot be exploited proportionally. So this is basically a political risk that heads of state are making, whether or not to try to stick to the 2-degree limit. If that is the case, it will immediately and likely lead to a devaluation of the value of oil and gas companies. And similarly speaking, I think on the natural capital side, we did a study called E-Risk, which focused on the importance of environmental factors in sovereign credit ratings. I think everyone knows that weather extremes are starting to mount, but there's also a scarcity of water and natural resources. I think the Arab Spring is probably the most profound example of what can potentially happen in terms of that leading to social unrest. But we found that the potential risks are significant enough to affect a country's growth path and thereby also its credit rating, which basically gives a direct signal to investors: are you getting enough return for the risk that you're facing? So I do think that whether it's UNEP or whether it's Trucost or whether it's other organizations, I think there is a growing degree of evidence out there that showcases that the financial sector should really look at this. There are a number of solutions or programs that are working towards it. I've started a project called the Natural Capital Declaration that was launched at Rio+20 last year. At the moment, 42 CEOs of financial institutions have signed up, and a further 28 supporting organizations, including the TEEB for Business Coalition and Trucost. And I think it's important to see how we can try to mainstream natural capital accounting within the financial sector, providing the tools and the frameworks to enable them to do so. I also mentioned the Greenhouse Gas Protocol, where we've teamed up with them, and the objective is to come up with an industry standard for the financial sector, how to incorporate indirect emissions through debt, through equity and other financial products, and that financial institutions are better able to understand that. What are some of the leading institutions doing themselves? Sumitomo Mitsui Trust Bank was one of the Japanese signatories last year of the Natural Capital Declaration. Following that, they teamed up with PwC to come up with a new loan product that incorporates directly the natural capital exposure that that some of their clients are facing into the interest rates that are provided to clients, which in my opinion is a no-brainer, but linking ESG directly with financial analysis is super novel. The European Investment Bank has been calculating its indirect carbon emissions of project finance, and Citi also recently came up with a indirect carbon footprint of financing the power sector, and basically found out that it's 7 to 40 times higher than their direct emissions. So it showcases the magnitude of indirect carbon emissions through finance, also the indirect carbon, natural capital impact, and what financial institutions can do about that. So that's something that we hope to take further.
So for those types of investors, and for investors and businesses in the room, Richard, we've talked about the natural capital at risk study now a few times that Trucost did for the coalition. What does that study highlight as the headline priority sectors that if you're an investor, there is a potential risk and opportunity that you need to know about?
I think it highlights risks and opportunities in equal manner. So really the risks are obvious, pretty much. We're talking about a complete, if you equate the financial risks associated with climate change to the revenue from coal-fired power generation in North America, it would pretty much wipe off the revenues, forget about the profits. So really we are sort of investing today, or investors are investing today, in something that either will become redundant because of regulation, or if not, then we'll live in a very different world. So those are the choices we face. The other issues are related to things like water and land conversion. So what we found was that if you're looking at cattle ranching in South America, because of the level of land conversion, the effects of that on water, grain production in various different places in the world, that you would essentially have to pay about 19 times the amount you would normally pay for a beef burger from South America. So really, again, 19 times revenue of that sector in that region. So quite significant financial risks. Doug, you raised something interesting about when externalities become internalized, and that being a sort of issue of, I guess, timing and also materiality to companies and their investors. I think one thing that's interesting is that 638 companies are next month in Shenzhen province going to be piloting a carbon trading scheme in China. The levels of pollution in Beijing reached 758 on a scale of 0 to 500 in January. It's not going to take very long for the Chinese government to actually say, actually, polluter, you pay. Polluter pays regulation. And the cost of that is really significant. So the Chinese government itself has estimated the cost of air pollution to its own nation in GDP terms to be nearly 10% of GDP. So the internalization of air pollution cost on the small number of companies in that economy that create that air pollution would again probably wipe them out. Now clearly they're not going to do that straight away, but to companies that are buying from Chinese manufacturers, to understand the potential financial costs, implications of what might happen in that regulatory scenario, that strong regulatory scenario, would be really important. On the flip side, it doesn't necessarily require regulation. So another thing the report found was that about 50% of externalities will likely happen and be internalized in markets without regulation. So these are things like water risk. Water risk and water availability and scarcity has driven an exponential increase in commodity prices since the turn of this century, when all across the last century, commodity prices in real terms fell by around 1 to 2%. So in short, raw material costs are only going to go one way. They might vary a lot, there's a huge amount of volatility, but they're only going one way, and that's quite a lot of that is being driven by water. So really what the report identifies is quite a significant financial risk. The opportunity is the flip side of that. So where should we be sourcing from? Where should we be manufacturing? How should we be manufacturing? So I think a lot of the forward-thinking investors are actually examining the flip side of that risk equation and saying, actually, where is our opportunity to minimize externalities? Where is the delta, the difference between business as usual here and a company that has really invested in a sustainability program that will drive a positive net present value?
And Richard, you mentioned sectors like cattle ranching, construction as being high risk in this area. What other sectors should be concerned about this issue? Sectors like energy, for example, should they be concerned? Yeah,
energy and food retailing and all those kind of sectors. In fact, you know, pretty much every sector is interconnected and exists as part of a value chain. And so you have knock-on effects. For example, a clothing retailer will find that a switch to a sort of polyurethane-based product away from a cotton-based product because of the rising cost of cotton will affect the price of polyurethane, which will drive up the price of that commodity product in a sense. So we have interrelated effects between various different sectors. And the issue here is we operate in a global system. And that system can trigger very perverse effects instantly in ways that we don't currently analyze fully. So a little example, if I said the Arab Spring was caused by a drought, so some people might say I'm crazy. But in fact, because of a drought in East China, and China is one of the world's greatest demands of wheat, it severely affected their wheat production, so they started to import wheat. At the same time, Russia had a major fire and a series of droughts in 2010. That meant the price of wheat went up by 150%. Because 6.5 kilos to 8 kilos of wheat go into a kilogram of beef, that meant the price of food overall doubled. Now, in this country, you spend between 5 and 10% of your income on food, whereas in the Arab nations at the time, you might be spending 40 to 50%. So if the price of food doubles and you're already experiencing civil unrest, you're going to have a touch point there enabled by technology that will spread like wildfire, which is exactly what we saw. So that's why the CIA would say that water is our greatest risk globally.
And Francis, when we start to look at these things, measuring externalities, it can bring up some challenges too, and often, particularly in the energy sector, stranded assets are talked about. What is your view on that?
Yeah, Ivo mentioned the carbon tracker report that came out recently, the sort of unburnable coal. But I think one of the benefits of the term stranded assets has become the sort of the new buzz term when you're talking to investors about sustainability, because it is something in their language. So this is actually something that's sort of enabling us to get a message across. But so stranded assets are basically, you know, assets that can appear on the balance sheet that will have their value will be affected by changes in legislation, regulation, or even license to operate. So it can be sort of in terms of the oil and gas companies, the fact that they have fuel reserves on their balance sheet, you know, which the shareholders are sort of, you know, seeing as part of the valuation, and then also seeing, instead of getting dividends back, that more money is going into sort of, you know, trying to sort of explore for new reserves as well. And so perhaps that money should be redirected in some way. It can also happen in terms of water availability. If there isn't water availability and you've got a huge facility in an area that requires water, then obviously you're going to have to shut that down a lot earlier than expected. And we've seen examples of power stations shutting down early just because, you know, they haven't got the access to water that they would, you know, that they would need for the long term, and the cost is too expensive. So I think sort of understanding beyond, you know, what's the company's direct emissions, and if there was a carbon price, what would that effect be? You know, there are many more sort of aspects that investors are beginning to wrap their sort of minds around. But as Richard sort of says, you know, it's sort of these knock-on effects and the sort of interrelatedness between the sectors. I mean, for companies at the same time, you know, for us at CDP, it's really about business resilience. You know, have they got a business model that is going to work in 10 years' time, in 20 years' time, or not? And, you know, if you don't know whether scarce natural resources are going to basically, you know, shut down your whole supply chain, you know, if you don't know how regulation is going to impact your facilities or your whole supply chain throughout, or how different policies might incentivize your customers to have different sort of buying choices, you know, then you don't really know if you've got a business model that's going to enable you to continue to be profitable. And but that's the more long-term thinking. And I think at the moment we have a lot of examples of how investors are using CDP data. But it's generally, you know, it's sort of the niche sustainable ESG type investors. For example, we know we have our data stream through Bloomberg. We know there are 1 million downloads of CDP indicators every 6 weeks through Bloomberg terminals. We know that HSBC and Credit Agricole Chevreau use our data for broker reports, you know, on water scarcity, or on, there's one called the ETS Spring, looking at regulation around the world and the effect on European companies. We know NBIM in Norway, their portfolio managers use CDP data for risk screening and risk mapping, you know, before they make decisions. And we have our own carbon action initiative where we have 190 investors who are actually prepared to tell companies in high emitting sectors they want to see reductions, they want to see targets. And if they don't see that, they'll go and engage with them either collectively through the UNPRI or individually. And then the CCLA, which is a great fund manager for charities, churches and local authorities, have started a coalition called Aiming for A, where they're actually targeting 10 UK companies in the sort of oil and gas, well, utilities and extractive industries. And there's a whole coalition of mutuals now asking these 10 companies to aim for A in terms of CDP scoring, because that's sort of representative of good performance, you know, good reductions. So there are some activist investors, but it's just not enough at the moment, and it's not mainstream. And many investors would argue they're doing as much as they can with the information available. You know, there isn't a carbon price, you know, it's all a bit worrying, but what are we meant to do? So I think things like stranded assets sort of start to shift the mind. But in my view, you know, we really need to start to unpick the relationships in the financial industry. My background was in finance. I kind of think there's a sort of concept of other when it comes to the financial markets. You know, everyone's slightly in awe, you know, sort of, and sort of whenever there's a sort of ethical issue, they sort of want to be as removed as possible. I mean, I don't, you know, has anybody in this room not got a pension? 3?
There's a few hands are creeping up.
You know, I don't know if you'll never have one in your life, but you know, ultimately, the fund managers are there to serve us. You know, we need to. I hear from fund managers that they find it hard internally to make the business case to look at the emissions in their portfolio, for example, or you know, do more integration of environmental aspects. Now, they find that business case hard because they're not being asked to do it by their client. Their client is the asset owner, the pension funds. The pension funds are not asking, you know, I mean, they obviously, yeah, there are examples of them asking through things like the PRI, but they're not asking as a sort of huge kind of driver, because the trustees of pension funds don't think we think it's important. And, you know, they think all we want is the financial return, and if you carry on in the same model and you don't break it in any way, then hopefully, fingers crossed, in, you know, 50 years' time, if you're sort of 20 years old, everything's going to give you a return. Well, you know, it probably isn't. The model's broken, and we need to really sort of help people understand that and use those levers to enable them to actually start to integrate this properly.
So there's a real disconnect at the present time. And thinking then of the next steps and moving beyond that, we have a number of approaches that are coming out. Douglas, what would be your thoughts in terms of the challenges going forward on those next steps?
May I just comment on something that you said, Francis, which was about, I mean, you talked about investors and how they're starting to use the information, and they're starting to make some differentiated decisions on the basis of that. I mean, what I'm seeing in terms of investors is there are some that are making the decisions from an ethical perspective, and it's primarily, you know, we're going to engage around this topic because there's a very strong ethical basis for us engaging on it, as opposed to actually making rational decision making, because I don't think actually investors have the right information for rational decision making on how the sustainability agenda, sorry I'm using the S word, is actually going to affect the long-term success of that organization. I just don't think the information's there. There's a lot of information around carbon emissions, there's a lot of information around water risks, but actually there's very little information on how does that affect the long-term viability of the organization or the project that I'm looking to invest in. And so there's the opportunity. We need tools that actually support that decision-making for investors, but we also need the tools that support decision-making at a corporate level. So if you think about organizations that are really striving forward on the S agenda, they're largely motivated organizations that recognize this is the right thing to do. They kind of understand the intuitive business case behind it, but they don't have the tangible numbers behind it. If we had the tangible numbers behind it that really demonstrates how this affects the success of this organization for the long term, you'd get much better corporate decision making, you'd get much better decision making on behalf of investors. So what's standing in the way right now, which I guess was your question, so sorry, I am getting to the question. I think one is a lot of organizations that we work with, they don't have the confidence in the valuation tools. They see the numbers coming out of the tools, but actually they struggle to say, well, what does that actually mean? What does it mean and how can I rely upon it? Because the science behind the valuation of externalities is inexact. And then it's the next question, so what does that actually mean for my business? It's all very well and good, we're putting a number on a ton of carbon, but actually what does that mean in terms of what that means for me and the long-term decisions that we need to make? So, I mean, the way organizations need to start is actually understanding the connection between the impacts that they have on the environment, the innovations that they can bring about to reduce the impact on the environment, the different decisions they can take, and how that links to the core value drivers in the business. And I think that's a really good starting point in that mapping. And then you get to the stage, well, how do we actually start to link and attribute real values to that, such that you can build some sort of decision-making framework? Now, some of it's really easy to measure in terms of cost reduction associated with energy efficiency programs. You start to get into more difficulties when you start to quantify the reduction in risk associated with water scarcity management programs or sustainable agriculture. But then when it comes to some of the intangibles associated with action in terms of how does that affect the customer behavior, then it starts to get very tricky in terms of valuation. But we do need to have a much more pragmatic framework for that, not just across carbon and water, but across a broad range of impacts, including biodiversity and different habitats. And there's a long way to go. And I think Trucost, you've done some amazing work in this space. And there's opportunities for further development and really starting to think about how do we create really effective decision-making tools, both for companies, but also for those in the financial services sector, looking at how they engage with or invest in companies.
Great, so information, toolkits for business, these are all clear next steps. So I'd really like to open out the floor now to questions. We have one just up here in the front. Any other questions, so we can see where the mic needs to go next? Just over on that side, great. Please.
Oh, good morning. Thanks for that interesting conversation. I'm Robin Wood of the Thrivability Consortium, and wanted to go to, well, all of you mentioned the word opportunity, but Steve specifically mentioned the word innovation. And we've all talked about tools for 2 days, but the looking at business from the perspective of disruptive innovation particularly, because we like to use the word, but not many people do it, actually. There are very few case studies of disruptive innovation. I know I spent most of my life sort of working in that space, and there aren't many you can mention in many industries. So if we really need disruptive innovation, which is I think what we're talking about, you have to have the tools and you have to have the data. And you mentioned two problems. So I want to just ask the panel, what we can do about this. One of the solutions we've come up with is basically to take a sort of GRI approach to this. Yeah, and to build on what the GRI has done, but to actually standardize one thing, standardize the definitions that every company has to fill out to 30 different data suppliers who are taking that data and pumping it into the markets, going to the raters, and so on through the loop. That's the first thing. So what are your thoughts about how we can do that, top down particularly? And the second thought is really around the tools. There's some fantastic business modeling framework simulators on the internet. There's tons of stuff. Sustainability is being brought into that. Not thrivability yet, but sustainability. But thrivability is a motivator for people to do it. It's the reason you do the innovation. And this is what we're missing, because if we just focus on minimizing impact, that's what we'll get, and we'll get less of it. If we focus on maximizing some sort of benefit, it's the oldest trick in the book in business anyway. That's what business does. So those are two questions I have for the panel.
Okay, so big issues there. Just thinking of time, if we could keep it as succinct as possible, just in terms of our panelists, this is how we can get in the disruptive change, how we can develop the tools, thinking of what we already have, initiatives like GRI. Who would like to start on that answer? Frances.
I can talk a little bit to the tools more around the valuation side of it and standardizing and this, Robin. I mean, at CDP, we've been asking companies to report on their risks and opportunities, you know, sort of since the start. But we've been really trying to accelerate the sort of valuation side by, as part of our scoring, awarding a lot of points towards companies that are able to put some sort of financial value on their risks and opportunities. And sometimes, you know, people look at it causes a lot of controversy. The insurance companies hate doing it, whereas I would assume they're the only people who would know how to do it. But they sort of constantly, it's not standardized, what are we meant to do? It's like, well, you know, surely your whole business model is based on some concept of understanding what these risks are. I've seen investment banks where the broker side has actually put out a note saying companies should be prepared to give this information. Then the CSR department has told me that they don't believe in doing a finger in the air thing and wouldn't report on it themselves. So I think there's a lot of, there's a lack of confidence around these kinds of numbers. But I think what we're doing is right in that we're allowing people to put stuff out there. The quality might not be good. Everyone can sort of say, oh, you know, one person said, oh, this could affect our brand value by 10%. Our, you know, market valuation is this. If you take 10% off, that would equal that. You know, it's way too basic. But once you get these things out there, then we'll start to look at the numbers and get it right. If we all sit back and wait for a perfect methodology, I don't think it's going to happen.
Did you want to add to that, Richard?
Yeah, just to add to the point on standardization, I think one analogy would be, I mean, this is imprecise, first of all. It's forward-looking. It's a real challenge, actually. It's a challenge of getting, for a business, it's a challenge of getting data on your entire value chain, not just your operations. So that's pretty challenging. And, you know, since the 50s, 60s, businesses have been outsourcing operations to developing nations and seeking one thing back, which is price. That means we've lost a lot of information. And the job is to get that back somehow, and that's a real challenge because it's that information we need to be able to refine these kind of measures and to understand business more fully in today's world. But that's not to say we shouldn't do it. So anybody who's done a discounted cash flow analysis knows there's uncertainty. What terminal value do you use? What discount rate do you use? Anybody who has looked at how oil reserves are stated and calculated knows that's imprecise. What I would say is, you know, where is a food retailer's water reserve? That's what we should be looking at, because it's these stocks that we rely on that are going to drive business value in the future. And the business value of the future is what should be analyzed by the financial markets in terms of their earnings forecasts. So it is imprecise, and I think there's a lot of work going on about how you get more precision. There's quite a few initiatives, of which TEEB for Business Coalition is doing some great work in this area. And I think that's really where we need to focus. In terms of just briefly on disruptive change, just a small story. If you imagine, a lot of people might say Saudi Arabia is essentially one big stranded asset. It has a primary business of extracting oil and exporting it. Yet they've done two things, made two announcements recently that I found quite interesting. The first one was to say that by 2016, I think, the entire grid will be solar powered. Why? Because it makes pure economic sense. They sell oil at around $100 a barrel, say, and they sell oil to themselves, energy, at $4 a barrel. So between 100 and 4, they can buy as much solar as they wish to create their energy, and so keep the change. And so there's an economic rationale there. The second announcement is that oil should continue to be dug up, but it should be captured in products rather than burnt. So imagine then if you pair a view that we should be continuing to dig oil up and converting it into plastics and clothing and shoes, with a view that we should not be creating leather-based products, especially from places like South America, where they're significantly contributing to climate change. Then you have disruptive change, but that requires an analysis between value chains and of the entire economy. So it's not easy.
Definitely something to ponder, the implications there. Mike, you had a question.
Quick question and a quick answer,
Yeah,
please.
this is our last one, unfortunately.
Quick question. Mike Tennant, Imperial College. I'd like to ask the panel how far they think we should be taking valuation of natural capital. It seems to me that as soon as we start monetizing this, as soon as we use money as a proxy value for value, then we potentially get down the slippery slope where we're securitizing subprime mangrove swamps. And we have this Arab Spring problem where somebody can buy up some tracts of land and destabilize across the globe. So if we're using money as a proxy for natural capital, is that a proper position to take given that we're after net positive impact?
It's a good question. Thank you, Mike. And if I could ask the panelists, we do really have to keep it short. Ivo, you wanted to come back on this one.
I think there's a difference how the financial sector would deal with this and how companies close to the ground would deal with this. I think the financial sector is not in the business of putting a price on that natural capital. They're in the business of putting a price on the risk they're exposed to in relation to natural capital. So in that sense, I think the sky is the limit. The further we go, the better it is on the risk side. I think there are issues in relation to putting a price on nature per se. In terms of commoditizing nature, I think they're both good examples. What has happened in the case of Costa Rica, New York, and a few other examples, but there are also many other examples where it can turn sour. I think the issue of so-called land grabbing or land investments is probably a very strong one in that respect, where ecosystems power the growth of agricultural commodities on which nations depend that don't have them themselves. And rather than work on it in a collective way, there is a movement now towards trying to secure these. So I think there's definitely issues that need to be tackled there.
And I think this very much also comes back to your earlier points, Douglas, in terms of how do you use this? And that is a key gap at the moment. So a value is one thing, but what is the application? That's really the relevant thing.
Yeah, I agree. Can I add one point, though?
If it's 100% quick, just because I'm getting the evil eye.
Valuation is not the be-all and end-all. And it's not going to solve all of the problems. I know the World Business Council accountant's supposed to save the world, and that kind of alluded to the fact that valuation will solve a lot of the problems, and it will, but it's not the be-all and end-all. You know, there are a whole range of ecosystems that have value in their own right, regardless of the extended value that they bring to society and to economies and companies. So it's not the be-all and end-all, but it is a very useful tool.
I'd like to thank all our panelists for such an interesting conversation on this emerging topic, and to all of you in the audience and for your inputs. Thank you so much.